Hey everybody, in today's video, we are going to look at a client presentation. This is someone who has been considering high cash value life insurance and he wanted to see a number of different policy options. Before I prepared this recording for him and I had actually met together. We had a lot of correspondence via email. Then we connected over a Zoom call just to discuss his goals. I got an overview with respect to what he was looking for, but some of the main questions we will answer in this video that you'll see is he had some questions with respect to how much should I add to this policy? He had a number of $50,000 in mind, but wanted to know what would the policy look like if we went with $100,000, but also what's it look like if he goes with the 100K option, but he doesn't get that much in, meaning he bites off more than he can chew. And then we also looked at different funding periods, 10 years and 25 years. So we're gonna cover a lot in this video. I hope you enjoy it. If you do, please hit that like button, subscribe for more, and leave a comment below. Enjoy. Happy Friday. I hope that all is well with you and the family. So in this video, I am going to provide an overview and talking points to the Excel spreadsheet, the detailed illustrations, and really just some additional information to provide awareness on a lot of the things that we would likely discuss if we were going through the numbers during a Zoom call, or if you had them up in front of you and we were discussing it over the phone. Really, this is meant to provide additional information. This way you can make the best possible decision if you decide to move forward with a high cash value life insurance policy. Let's get on into the numbers. So, I have a lot of info up here. You may have had a chance to review the Excel spreadsheet already. Before I just jump into the numbers, because I'm going to go through the Excel spreadsheet and some of the detailed illustrations to help you identify what to look for in the illustrations, to have just reassurance that everything is set up for minimum expenses and maximum cash value. But before I do that, just to provide a little bit of a recap and the foundation for the numbers, is during our call earlier this week, you are primarily considering a policy where you can fund anywhere from 50, potentially up to a maximum of $100,000 per year, but are not quite certain as far as the number that you'd like to go with. You know, having a policy with a maximum of 50 is nice because that was a number that you felt like, hey, I can hit that and I'm very, very confident. But I might want more room to be able to add more funds into the policy. So a bit of a stretch would be $100,000, which is good. It is good to stretch. However, we don't want to overstretch and pick a number that we can never hit. So what I would want to see specifically, if I'm you, if you and I flipped positions and I had the knowledge as a consumer, but I had the knowledge that I have being in the industry, here's specifically what I would want to see is, what does a policy look like if I max fund it at $50,000 per year? Then what does a policy look like if I max fund it at $100K per year? But then what does that same $100,000 per year policy look like if I only pay in $50K per year? So with a life insurance policy, if we build it or equip the policy to be able to handle $100,000 per year in total payments, what that would look like is as follows. If you've got 100K going in, money can go toward one of two areas. One, toward the minimum premium, which we can drive as low as $10,000 with the major mutual companies, both Mass and Guardian. The scenarios I put together, I set it at a clean 10%, $10,000 minimum premium. We could go technically a little bit lower. We can go as low as about 9.1% to be precise with Guardian. If you do gravitate toward them, we can fine tune everything. But my point is, it's right around that 10% minimum. That's as low as we can go with Mass Mutual and Guardian. So focusing on the $100,000 number, what that would mean, you would have a $10,000 minimum premium and the ability, not commitment, but ability to throw up to another $90,000 per year into PUAs, which stands for paid up additions, dumping money right into cash value, which gives you a total of $100,000 per year. So if you were to max fund a policy that looked just like this with a $10,000 minimum premium, $100K per year, it would look fantastic. However, specifically what we want to look at is, what does it look like if you have this policy, but the maximum PUA you only get in is $40,000 per year. So it's still a policy with a minimum premium of $10,000, because when we look at the limitations, the insurance company will allow us to 10x our base premium. And then the MEC limit, we set it at $100,000. You may recall this, I know you've been doing research for a while. What has a direct relationship to the MEC limit are these two factors: an individual's age and total death benefit. The guaranteed rate and gender does have a role as well, but age and death benefit are the primary, call it measuring stick, that the IRS uses to determine if that life insurance policy will be viewed as life insurance and then reap the cash value benefits, safe, liquid, tax-free, or if they'll view it as a modified endowment contract, which then I have to deal with the tax consequences that come with MECs. So really what I want to see here is, what is the impact in policy performance? So if you fund 100K per year, if you max fund it each year, it'll look good. However, if you only paid in 50K, like we see here, when I built the policy to be able to handle 100,000 per year, in order to get that 100K MEC limit, I had to raise the death benefit with a larger term rider. I have a $10,000 base premium instead of $5,000. What is the drawback? What's that cost me in terms of break even, cash value performance? Seeing that upfront really helps individuals make a refined decision to know, okay, this makes sense. I'm comfortable building it out with some more space, because if I don't max fund it, it's not that much of a difference. Or one would say, too much of a gap. Let me start out with a 50K maximum, because I know I can hit that and I can just juice this policy from start to finish. So I put options together with both, whether that premium is 10,000 or 5,000. Typically 0 shows up in cash value in the first year. You'll see that with the Guardian product options. With Mass Mutual, I actually ran their high early cash value product. And what you'll see with that guy, Mass HECV, is in the first year, you get about 80% of the premium that shows up in cash value immediately. That's in addition to any dollars that go toward PUAs as well. So it's nice for early cash value. It's about 92% of your total payment. Long term, it's not quite as strong. So I'm going to go through the numbers. Before I do that, though, one last thing I want to touch on here is the sweet spot with both companies, which I feel like you've got a good grasp on this. You picked it up very quick during our call. And I know you've been doing a lot of research as well, but just to reiterate this and also have it on a recording for you so you can refer to this as many times as you like. When we look at Mass Mutual and Guardian, 2 of your 4 major mutual companies, which really means when we look at real policies that have lived the test of time, not illustrations, we have seen them consistently deliver the strongest internal rates of return, another way to put it, the most money to policyholders. So if I were to look at the sweet spot with these carriers, meaning how do I just juice the cash value, or what are the advantages of each company? Here we go. So Guardian, definitely in their PUA flexibility. They are extremely flexible, where if you have a policy, we use the $100,000 example with Guardian, you can set it up where you are only committed to the minimum premium, that plus the term rider. But if the premium's $10,000 and the term rider, let's just say, is $1,000 per year, you can literally commit to that each year, $11,000 per year, which could be paid yearly or monthly. And then 100% at your discretion, you can just throw money into PUAs. So when I say PUA flexibility, it's a matter of adding money into PUAs at leisure. And that can be done through your mobile app, online portal on a laptop or tablet. You can send in the check, whatever is most convenient. So they do have a ton of PUA flexibility. A lot of people who are cash flow sensitive, real estate investors, business owners, really like Guardian because they view it as a product where they say, hey, I can commit to a minimum amount that never feels like a burden. I can do it in my sleep almost. And then when the cash flow comes in, because it's never consistent with respect to when it comes in, at that point in time, I can throw the money into the policy. Then I have no pressure with respect to how and when I have to add that money. A lot of people have expressed comfort with Guardian for that reason. So the PUA flexibility, big advantage in my opinion. We can commit to the minimum premium only. Now here's the thing for people who are interested in maximizing the IRR. With Guardian, if I want to just juice that cash value, their product is best suited for someone who says, I want to be able to pay into it, or my plan is to pay into it for 10 years or less, or I'm going to max fund this thing. So if your goal was to pay in 100K per year, and let's say it was 100K per year, you got it in for 10 years, maybe that's a combination of catch-up payments if you make up for lost time, but let's just assume $1 million over 10 years. After 10 years, you said, I'm done. After 10 years, from year 11 onward, I'm going to pay nothing in, or maybe just a reduced amount. Maybe it's 20,000 or 25,000 where I still have that base premium of 10K, but I won't be able to max fund it beyond the 10th year. You can set it up where you can max fund it longer. It is very possible and actually easy to do that, but you will find just with what one has to do with the term rider and such, it's not as attractive. The IRR will suffer. Often when you look at the policy and think, that's just not what I'm attracted to. I'd rather go with a different option in that respect. So to summarize, Guardian's sweet spot is in their PUA flexibility. And if someone says, hey, I like the idea of max funding this thing for 10 years, maybe it's 5 years or less, a limited number of years, and then stopping or paying a reduced amount, call it just the base premium. In a case like this with 100K MEC from year 11 onward, you could easily pay 20 to 25K without having to worry about a MEC for at least 20 to 25 years. Mass Mutual, their advantage, ability to fund with a 1090 split for a long period of time, which can be forever. You can do it for 50 years if you wanted to. So where a 1090 split is advantageous, particularly with Mass Mutual, is that is as low as they will allow us to go on the base premium, 10% of the total desired payment. So that maximizes the early cash value. It also maximizes the long-term cash value when you look at historical performance and guarantees. But maximizing upfront cash value and being able to pump money in for a long period of time, that's their advantage. With the different riders that are available with that product, you can just stuff the thing for a long duration of time. The disadvantage to some, I should say, is with respect to the flexibility. So they do not have the same PUA flexibility as Guardian, where I could log into my portal every week and dump money into PUAs if I want. That's with Guardian. With Mass, if I want to keep things convenient and avoid any type of medical underwriting, Mass Mutual is best suited when one is comfortable making a one-time per year payment adjustment. So specifically what that means is if year one, you said, hey, I'm going to start things out and pay in 100K. Year two, I'm going to pay in 50K because things were slower. If 6 months into year two, I said, I can pay another 50K up to my MEC limit. I have the money now. I'd like to throw it into the policy at random. You can do it with Mass Mutual, but in many cases or many circumstances, they come back and say, well, before we accept your money, we want to put you through some type of medical underwriting. They do have a rule that allows 3 unscheduled payments per year. The number has to be underwritten up front, and there's a couple other pieces of information to be aware of. There's a 2-year window and such. I can go through that in detail, but to simplify things and where people really thrive with Mass Mutual policies, where it keeps life easy for the consumer and they don't have to track things, is in this case, going back to this, year 2, you paid in 50. If you wait until year 3, then you can increase the payment back up to 100. You could even increase it up to 150 to make up for lost time without any underwriting. So if the adjustment occurs one time per year, and specifically
it falls on our policy anniversary date, that is how we avoid underwriting. So for example, if you started your policy in January, what that would look like is January, you make the payment. Next year, you say January has rolled around. I want to adjust my total payment to X amount of dollars, 30,000, 50,000, 100,000, whatever the total dollar amount is that you'd like to add to the policy. Now, it does not need to be the exact day of your policy anniversary date. It is technically a 60-day window where we can adjust the payment between 30 days before through 30 days after the anniversary date. That's when we can send the funds in. So to summarize with MassMutual, 1090 split minimum premium, the ability to pay into it for a long period of time without having to worry about a MEC or anything like that. If I'm comfortable with a one-time per year payment adjustment, that's where they work quite nicely. Guardian, on the other hand, ton of flexibility, but if someone says, hey, I'm good with 10 years or less, and maybe I'll still fund it, but at a lower amount, that's where Guardian would work well, and you could really maximize the IRR. So what we're looking at here is, how do we maximize the cash value first and foremost? Make sure the policy accommodates your needs and wants with respect to how long and how you'd like to fund it. And then step two would be looking at using the money, meaning when you borrow against it, when you take loans, what's that look like if you pay it back? If you don't pay it back, if you pay interest only, which we can look at certainly as we start to narrow things down with the company and product selection. And we can look at it with as many companies and products too. Typically, we'll always start with going through the growth first. So let's continue on here. Here we go. So you've got 4 tabs, the bottom left-hand corner of the spreadsheet. First tab, 50K and 100K MEC limit. So these display policies that are funded right up to the MEC limit. So for example, these two, 50K for 10 years, 50K for 25 years. So I ran 2 options here, but they're the exact same policy. Both have a $50,000 MEC. Right around that, I overinflated it a little bit, but here we go, $5,000 or $50,000 total payment, $5,000 minimum premium, immediate cash value right out of the gate, it's about $46,000 and change, breaking even between years 4 and 5. HECV represents high early cash value. So the nice thing about MassMutual, and this demonstrates it, if you fund it at 50K or up to the MEC limit for 10 years, you can do that. And then if you said, you know what, I want to keep going. Maybe it's for 11 years, maybe it's for 15, maybe it's for 30. You do not need to choose up front, but you'll notice these are the exact same policies, identical here. The only difference is this guy represents what the numbers look like if you decide to continue to pump money into the policy at 50K per year, which obviously gives you more money, which doesn't hurt. Progressing to the right, exact same thing. Everything is just doubled. So 100K per year, breaking even between years 4 and 5, just like the 50K example. And then over here, you continue to fund. While this has 100,000 per year going in, you are not obligated or required to pay the 100K per year each year. You've got the $10,000 minimum premium. So this is the 10-year fund we just looked at on the spreadsheet. If I'm you, if we flip positions, again, what I would want to know is, how do I know that this policy is truly set up properly? Because these things can be confusing. People look at them and they think, okay, I think it's set up properly, but it's difficult to follow, especially if you're not in the industry and don't live and breathe it every day. So if I'm you, what I would look for is this. Here's the total payment. This is a policy with $100,000 per year going in. So if 100K is my desired maximum, money can go where? Premium, which is right here, 10,000 at the minimum 10% MassMutual will allow, or toward PUAs. Now we've got the Lister piece, which is their blended PUA rider. So there's a combination of 1-year term insurance. The rest goes toward PUAs. In this example, in your case, the actual term cost is going to be right around $800 or so. I can get the exact number Might be a little bit less than that, but it's very, very cheap initially. And eventually we do cut that term rider as well. But I can go through the year-over-year cost if you would like. And then AILR, additional life insurance rider, is a pure PUA rider. So to go back to the lister, the term piece is $800. What that means of the 5,000, the other 4,200 would be directed toward PUAs. I've got a total of 100. So we have the policy set up with a minimum premium, maximum PUA allocation. The other thing I want to look at here, bottom right-hand corner of Mass Mutual illustrations, we see the MEC limit. Now, the MEC limit, I overinflated this one a little bit, mainly because I ran the exact same policy, but with you funding it for 25 years or for a longer period of time. So when we put policies together where someone wants to fund for a long duration, what I like to make sure of is based on present dividend rates, but also conservative dividends. I even like to look at the guarantees, is will that policy ever run into a MEC issue long-term? When you stress test a policy, it's very important to look at that. And typically what happens with the MEC limit is every 7 years tends to do this. Now yours doesn't quite do that with the way it's set up. It's a very, very slight decrease, but we do overinflate it to build in some window room. And the short answer or short explanation is I boosted it a little bit to make sure we never run into a MEC in any environment. That is the Mass Mutual illustration, giving a demonstration of where your money is going. Let's go back to the Excel comparison sheet and wrap things up. Second tab, max fund versus underfund. This hits on the main question we started with. Where is your money going? Well, premium or PUA. But what does it look like if I have a policy where I can pay up to $100,000 per year, but I don't do it? So this gives a nice side-by-side comparison. I did this just with Mass Mutual in this example. Progress on to Guardian next. Is $50,000 MEC limit, $5,000 base premium, $50,000 total payment, 46 in the first year, breaking even between years 4 and 5. Progressing on to the two examples on the right. $100,000 MEC limit. Look at your annual outlay here. Base premium, $10,000. Total payment, $50,000. So this is a policy where you can pay up to $100,000 per year, but we're demonstrating what it looks like if you do not pay that much, if you only paid in $50K per year. So this allows us to demonstrate what the costs look like and what the performance gap looks like if you bite off more than you can chew in that respect. So right off the bat, not a huge difference, about $1,000, a little bit more. Break even point, instead of falling between years 4 and 5, it's a clean year 6, meaning you've paid in 300K, excuse me, and you're at 300K. By year 10, 552, 568. If we look at this with the 25-year funding option, you'd see a bigger gap, but it is all relative to how much you pay in. So not a huge gap, and this is partly because you're starting at age 39, so it's not a huge difference there. How I like to think about this, if you say, okay, the difference here, 568 versus 552, that's about a $16,000 difference. Is the $16,000 gap in cash value worth it? Specifically, is it worth having the option to be able to pay in more money to an existing policy? So to have $16,000 and less in cash value over 10 years, to have the ability to pump more money into this policy. For example, if you're 3 or 4 years into it and you said, hey, I want to throw another 50K into an existing policy before opening a new policy, going through the startup costs again, that'll be in your best interest, adding to the existing policy. What I mean when I say that specifically is when you look at the pure cash value performance, the internal rate of return, adding to an existing policy that is already over those expenses will end up giving you a whole lot more money. You don't have to go through the startup costs again. So that's where people like to build in some additional window room, but at the same time, see the pros and cons here so we can compare it side by side. And then on the far right, we've got an example with the 100K MEC limit and you max funding it. So just to be clear, the middle example and example on the far right are the exact same policy. Why you see a little bit higher death benefit on the example on the far right is this guy has another 50K going in, which went into pure PUAs, ALER in this case, which does push the death benefit up. And you'll see that reflected on the detailed illustrations as well. Looking at the Guardian examples, here you go. So 5K minimum premium, 50K MEC limit. Actually ran a 5-year funding demonstration here, just to mix things up a little bit, which is fun. Breaking even right around year 5, which is common with Guardian now. If you've seen our older content, everything before 2022, really in late 2021, Guardian policies would always, or not always, but very, very frequently break even at year 4 if everything was set up properly. And that was prior to the 7702 changes. With the new Guardian products, we have lower guarantees, which is not impacting the break even. Guardian and just about all companies have increased their PUA rider fees. That's what's pushing the break even out. Also, the old product in this example would give about 44,000, or here we've got about 41.5. So as a result, just a product change, if you're looking at older videos, that's what's going on here. But still optimized, breaking even year 5 in this example. And then progressing on to the right, 100K MEC limit, but only paying in 50K, just like the Mass Mutual example. What I did in this guy was pay in still a total of 500,000. So you could pay up to 100K per year. You've got a 100K MEC limit, $10,000 minimum premium. So you've got the ability to 10x it per year, each year, I should say. Breaking even, just about year 6, but it's technically not year 7, which is why I made it year 6 and 7. There we go. And then on the far right, the 100K max, funding it just for 5 years. And let's look at the next tab. This will answer some questions with respect to the funding limitation. So we started off with Guardian sweet spot. One of the things I started off with being having a policy where I can max fund it for 10 years or less and then stop or cool off on my payments. So what I demonstrated here is the policy with the 100K MEC limit and what it looks like if you max funded it for 5 years instead of 10. We can easily design it where you go for 10, but for 5 years and then stop. And then the exact same policy, but with 5 years, same 10K base premium, but if you continue to pay the 25K per year, and you could pay more than that. Just the thing is, if you continue to fund it at 100, eventually it would fall down to a maximum of 40K. Once the term rider burns off, you'd have to stop funding right around age 50 or so, or reduce payments. This is an example of what you could easily do without having to worry about a MEC or anything like that occurring long term. But it does demonstrate, hey, I can max fund it initially and then continue to fund it if I want without sacrificing performance. It still optimizes the IRR with the Guardian policy. But it just really demonstrates what you can do with the policy if you wanted to, if you decided to go with Guardian. So I'm going to wrap up now just with one of their illustrations as well. But to touch on the main thing here, where's your money going? Premium, $10,000. That gets you a whole life death benefit of about $527. If we stopped there, that would give you a MEC limit of right around $23,000 or $24,000, right around that dollar figure. Here we've got a MEC limit of 100K, which the MEC limit has a direct relationship to the total net death benefit. That's the measuring stick our friends at the IRS use to determine if a life insurance policy is a MEC or life insurance in their eyes. How we get the 2.1 with keeping the premium low, because to get to the 2.1, there's 2 ways we can do that. One, we can increase the premium but that will sacrifice cash value, short-term and long-term, and also commit you to a higher dollar amount. But one way you could do it is by increasing the premium. That'll increase the death benefit. The other way to do it with this guy, target additional benefit, which is a term insurance rider, which is a cheap way. And if you don't like the word cheap, I'll refer to it as a cost-effective way to raise the death benefit, which raises the MEC limit. Here's the initial cost, $612. That's for the year. OYT represents 1 year term. And this cost too will typically gradually decrease. It can increase if we underfund it, but then we would just reduce the term rider a little bit, or cut it all together after year 7. It's typically a non-issue, but it is a very low cost here, and it will be all the way through. But that's how that works. A lot of info here. I hope that you found it helpful. If you have any questions, again, please feel free to reach out anytime. You can call, text, email anytime. We can connect over another Zoom call, whatever's most convenient, and we'll take it from there. Thank you again for your time earlier this week, and I'll talk to you soon.
Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.